You want to know something that drives me crazy? Every single year, dozens of stocks go up 10 times, 10 baggers, right under everyone's noses. And you know what happens? People miss them. Not because these stocks are hiding, not because you need some fancy Wall Street degree. They miss them because they're making the same silly mistakes over and over again. I manage the Magellan Fund at Fidelity from 1,977 to 1,990, and we averaged 29.2% annual returns. That made it the best performing mutual fund in the world during that period. And you know how we did it? By finding 10 baggers. Lots of them. Over 100 of them. Companies like Dunkin' Donuts, Taco Bell, Ford Motor, Chrysler, regular businesses that regular people could understand and watch every single day. But here's the thing that kills me. The average person who bought shares in Magellan while I was running it didn't make anywhere near 29% a year. Why? Because they got in their own way. They sold too early. They bought too late. They panicked when they should have been buying. They got greedy when they should have been careful. So let me tell you exactly why most people never see a 10-bagger, and more importantly, what you can do about it. Because I promise you, the next Dunkin' Donuts or Taco Bell is out there right now. You're probably walking past it on your way to work. They're looking in all the wrong places. Here's mistake number one, and it's a doozy. People think 10 baggers come from large cap stocks. They're staring at the biggest companies in America thinking these giants are going to go up 10 times from here. That's garbage. Listen, I love a good stalwart as much as the next person. Coca-Cola, Procter & Gamble, these are wonderful companies. They'll give you steady returns, maybe 10, 12% a year if you're lucky. They're safe, they're reliable, but they're not going to be 10 baggers. They're too big. They've already arrived. When I found Dunkin' Donuts, it wasn't a household name across America. When I bought Taco Bell, Wall Street wasn't paying attention. They were selling burritos for 59 cents, but they were printing money. These were small cap and mid cap companies with room to grow. Companies that could go from $50 million in market cap to $500 million, or from $200 million to $2 billion. The real 10 baggers come when a company transitions from mid cap to large cap. Think about it logically. If you've got a $500 billion company, how's it going to get to $5 trillion? It's possible, but it's going to take a long time and a whole lot of things going right. But a $500 million company getting to $5 billion? That happens all the time if the company's got a great product, smart management, and room to expand. So where should you be looking? Small and mid-cap stocks. Companies between $300 million and $10 billion in market cap. That's where the magic happens. That's where you find the companies that can actually grow tenfold. The big boys on Wall Street aren't paying attention to these companies yet. They're too small. They don't generate enough commissions. That's your advantage right there. Stay tuned, because I'm going to show you exactly which types of small companies have the best chance of becoming 10 baggers and which ones you should avoid like the plague. They sell their winners way too early. This is the one that really gets me. It's called the disposition effect, and it's probably responsible for more lost fortunes than any other mistake in investing. People sell their winning stocks too early and hold on to their losers too long, every single time. Let me explain what happens. You buy a stock at $20, it goes up to $30, you're feeling pretty good, that's a 50% gain. So what do? You sell it. You lock in your profit, you feel smart. Meanwhile, that stock goes on to 60, then 120, then 240. You just sold a potential 10-bagger for a measly 50% gain. Why does this happen? Fear. Pure and simple. You're afraid of giving back your profits. You're afraid of being wrong. You're afraid that if you don't sell now, the stock will crash and you'll look like an idiot. So you take your small profit and you feel good about yourself. But here's the thing, and this is crucial. You will never, ever get a 10-bagger if you sell after you double your money. It's mathematically impossible. A 10-bagger means the stock goes up tenfold. That means if you bought at 20, you need to see it hit 200. But if you're selling every time it doubles, you're getting out at 40. You're leaving $160 on the table. I've seen this happen thousands of times. A teacher buys Home Depot at $3. It goes to $6. She sells, feels great about doubling her money. 10 years later, Home Depot is at $60. She missed a 20-bagger because she couldn't sit still. The average investor underperforms the market by several percentage points every single year. Recent studies show the average investor earned about 3.6% annually over 20 years, while the market returned 9.5%. That's a 163% underperformance. And you know what the biggest reason is? They're selling their winners and holding their losers. Here's what you need to understand. The stock price going up is not a reason to sell. It's actually a sign that you made a good decision. The company is doing well. Earnings are growing. The business model is working. Why on earth would you sell that? You should be thinking about buying more. When I bought Chrysler in 1982 at $6, it went up fast. Within 2 years, it was at 30, a 5-bagger. A lot of people sold at 12 or 15, happy with their double. But I held on, and in 5 years, Chrysler was a 15-bagger. Because I understood the story, and the story wasn't finished yet. They don't understand the 6 categories of stocks. This is where most amateur investors really get confused. They think all stocks are the same. They're not. I've divided stocks into 6 distinct categories, and each one behaves completely differently. If you don't understand which category your stock belongs to, you're flying blind. Let me break them down for you. First, you've got your slow growers. These are the big, mature companies that grow at maybe 2 to 4% a year. Think utilities, tobacco companies, big industrial manufacturers. They're boring, they pay dividends, they're not going anywhere fast. And here's the key point, they will never be 10-baggers. Never. If you're looking for a stock that can go up tenfold, you can completely ignore slow growers. They're for retirees who want steady income. Second, stalwarts. These are large, well-established companies growing at about 10-12% a year. Companies like Coca-Cola, Procter & Gamble, Johnson & Johnson. They're solid, they're dependable, they won't go bankrupt, but they're also not going to give you a 10-bagger unless you're willing to wait 25 years. I use stalwarts in my portfolio for stability, for ballast. When the market got choppy, stalwarts kept me steady, but they weren't where I made my real money. Third, and this is where it gets interesting, fast growers. These are small, aggressive companies growing at 25% per year or more. They've got a great product, they're expanding rapidly, and Wall Street hasn't discovered them yet. This is where 10-baggers come from. This is where I spent most of my time hunting. Companies like Taco Bell in the restaurant business, Walmart in department stores, Gap in clothing retail, small companies in any industry that are doing something better than everyone else and have room to expand. Fast growers are exciting, but you got to be careful. They can flame out, they can run out of steam, they can get hammered if they stumble. So you need to watch them like a hawk. Check their earnings every quarter. Make sure they're still growing. Make sure the story is still intact. But if you find a good fast grower with a strong balance sheet and a product people love, hold on tight, because you might have a 10-bagger on your hands. Fourth, cyclicals. These are companies that are tied to the economic cycle. When the economy booms, they soar. When we hit a recession, they crash. Think airlines, auto manufacturers, steel companies, chemical companies. Here's the thing about cyclicals. They can give you amazing returns if you time them right. But most people do the exact opposite. They buy cyclicals when business is booming and everyone's making money, and they sell when times are tough. That's completely backwards. I made a fortune on Chrysler because I bought it when it was nearly bankrupt. Everyone thought the company was dead. But I understood the auto cycle. I knew that if Chrysler could survive the downturn, it would make enormous profits when the economy recovered. I bought at $6 in early 1982 when things looked terrible. 2 years later, it was a 5-bagger. 5 years later, it was a 15-bagger. That's the power of buying cyclicals at the right time. Fifth, turnarounds. These are companies that have been beaten down, have had serious problems, but are in the process of fixing themselves. They're bringing in new management, selling off bad divisions, restructuring their debt. Turnarounds are risky, but they can be incredibly rewarding. The key is figuring out whether the company is genuinely turning around or whether it's just headed for bankruptcy. I'll give you a hint, if the company is hemorrhaging cash and can't pay its debts, it's not a turnaround, it's a disaster. Stay away. Sixth, asset plays. These are companies that have something valuable on their balance sheet that Wall Street isn't recognizing. Maybe they own a lot of real estate. Maybe they've got a patent portfolio. Maybe they've got cash equal to half their market cap. Asset plays can be fantastic investments if you can identify the hidden value before everyone else does. Now here's why understanding these categories matters. If you own a fast grower and it goes up 50%, you should probably hold on or even buy more. The story might just be getting started. But if you own a cyclical and it's gone up 300% and the economy is at the peak of the boom, you should probably sell, because cyclicals always come back down. Most people don't make these distinctions. They buy a stock, they have no idea what category it's in, and they have no framework for deciding when to buy more or when to sell. That's a recipe for disaster. They have no idea what the company actually does. Here's a crazy thing I noticed during my years managing Magellan. Most people who own stocks couldn't explain what the company does. Not in any detail. They've got $10,000 invested in a company, and they couldn't explain the business model to a 10-year-old. This is nuts. How are you supposed to know whether to hold or sell if you don't understand the business? How are you supposed to recognize when something's changed if you don't know the story? One of my core principles, maybe the most important one, is invest in what you know. That means starting with companies and industries that you encounter in your daily life, companies whose products you use, companies whose services you understand. My wife noticed that pantyhose and egg-shaped containers were flying off the shelves. That was Hanes. I bought the stock, and it became a six-bagger. I liked Dunkin' Donuts coffee. I saw the stores expanding. I did some research, liked what I found, and bought the stock. It was a fantastic investment. You've got a huge advantage over me and every other professional investor on Wall Street. You know things we don't know. You're a teacher. You know which education companies have the best products. You're a doctor. You know which medical device companies are making breakthroughs. You're a retail worker. You know which stores are busy and which are empty. But most people ignore this advantage. They think they need to invest in complicated technology companies they don't understand because that's where the smart money's going. That's backwards. The smart money's going where there's something to invest in that makes sense. Let me be clear about something. Understanding a company doesn't just mean you use their product. It means you understand how they make money. You understand their competitive position. You understand their growth prospects. You understand their balance sheet. If I can't explain why I own a stock in 2 minutes, I shouldn't own it. If the story is so complicated that it takes half an hour to explain, something's wrong. The best investments have simple stories. They're selling cheap Mexican food in a fast-growing market. They're coming out of bankruptcy with new products and lower costs. They're building efficient stores in small towns that nobody else is serving. Simple stories. Easy to understand. Easy to monitor. That's what you're looking for. They focus on the stock price instead of the business. This is related to the last point, but it's so important I'm giving it its own section. Most people spend all their time watching the stock price and zero time watching the business. That's completely backwards. The stock price is just what other people are willing to pay for the stock today. It goes up and down based on all kinds of things, rumors, sentiment, market panics, whatever. In the short run, the market is a voting machine. It's about popularity. But in the long run, the market is a weighing machine. It's about earnings. If you own a great company, a company with growing earnings, manageable debt, strong competitive advantages, the stock price will eventually reflect that. It might take a year. It might take 5 years. But it will happen. The fundamentals always win in the long run. But if you're just watching the stock price, you'll panic when it drops. You'll sell at the worst possible time. Or you'll get too excited when it rises and you'll buy more at absurd valuations. Let me tell you what I watch. I watch earnings. Is the company making more money this year than last year? I watch the PE ratio. Am I paying a reasonable price for those earnings? I watch debt. Does the company have so much debt that it could go bankrupt in a downturn? I watch the company's expansion plans. Are they opening new stores, entering new markets, developing new products? Those are the things that matter. The stock price is just the output of all those inputs. Here's a specific example. When I bought Walmart stock, I wasn't looking at the chart. I was visiting stores. I was checking whether customers were happy. I was looking at how efficiently they ran their operations. I was calculating how many more stores they could open. I was reviewing their financial statements to see if they had the capital to fund expansion. That's research. That's analysis. Watching the stock go up and down every day on your phone, that's not research. That's just making yourself anxious. Let me give you a simple framework. Before you buy any stock, you should be able to answer these questions. What does this company do? How do they make money? What's their competitive advantage? How fast are they growing? What's their PE ratio compared to their growth rate? How much debt do they have? Why is this stock going to go up? If you can't answer those questions, don't buy the stock. I don't care if your neighbor made a fortune on it. I don't care if it's up 50% in the last month. If you don't understand the business, you don't belong in the stock. They're obsessed with low PE ratios. Okay, here's another mistake that trips up a lot of amateur investors. They think you find great stocks by looking for low price to earnings ratios. They see a stock trading at 8 times earnings and they think it's cheap. They see a stock trading at 30 times earnings and they think it's expensive. That's way too simplistic. It misses the entire point. A low P/E ratio usually means the market expects the company to have problems. Maybe earnings are going to decline. Maybe the company operates in a dying industry. Maybe management is terrible. There's usually a reason the P/E is low. And a high P/E ratio usually means the market expects strong growth. If a company is growing earnings at 30% a year, a P/E ratio of 30 might be perfectly reasonable. You're paying $1 of price for every $1 of growth rate. That's fair. I use something called the PEG ratio, price to earnings divided by growth rate. If a stock has a P/E of 20 and earnings are growing at 20% per year, the PEG ratio is 1. That's reasonable. If the P/E is 40 and growth is 20%, the PEG is 2. That's expensive. If the P/E is 15 and growth is 25%, the PEG is 0.6. That's cheap. The point is, you have to look at the valuation in relation to growth. A fast-growing company deserves a higher P/E than a slow-growing company. That's just common sense. Multi-bagger stocks are not about low P/E ratios. They're about companies at a tipping point, companies about to see disruptive growth in revenues and profits. Sometimes those companies have high P/E ratios because smart investors can see what's coming. When I found fast growers, I didn't automatically reject them because the P/E was 25 or 30. I looked at whether the growth was sustainable. I looked at the balance sheet to make sure they weren't over-leveraged. I looked at whether they had room to expand. If all those things checked out, I didn't care if the P/E seemed high by traditional standards. On the flip side, I've seen plenty of stocks with P/E ratios of 5 or 6 that looked like bargains but turned out to be disasters. The company was cheap for a reason. Earnings were about to collapse. So stop screening for the lowest P/E ratios. That's not how you find 10-baggers. You find 10-baggers by finding great businesses at reasonable prices and then holding on while the business grows. They don't have the patience. Now we're getting to the psychological stuff. And this is where most people really fall apart. Even if you find a great company at a good price, you still won't make 10 times your money unless you can sit still for several years. And most people can't do that. They get bored. They get nervous. They read something negative in the newspaper and they panic. They see another stock that's more exciting and they switch. They need action. They need to do something. That's poison for long-term returns. Here's what you need to understand. It takes time for a company to grow earnings tenfold. Even if a company is growing at an aggressive 25% per year, it takes about 10 years to grow earnings tenfold. If the stock price follows the earnings, which it generally does over time, that means it takes 10 years to get your 10-bagger. 10 years. Not 10 months, not 10 weeks, 10 years. Can you sit still for 10 years? Can you hold a stock through a bear market, through a recession, through a period where the stock goes nowhere for 2 years even though the business is doing fine? Through a panic where everyone's screaming that the world is ending? Most people can't. Most people sell after a year or two. They get impatient. They figure if the stock hasn't doubled in 18 months, it's not working. So they sell and move on to something else. That's how you guarantee you'll never see a 10-bagger. Let me tell you about Walmart. If you'd bought Walmart stock when they went public in 1970 and just held it, reinvesting the dividends, you would have made over 200 times your money over the decades. But to do that, you had to sit through multiple recessions. You had to sit through periods where the stock dropped 40 or 50%. You had to ignore the experts who said Walmart was overvalued. You had to hold through years when the stock went sideways. Very, very few people did that. Most people sold way too early. They took their double and felt smart about it. Meanwhile, they missed out on a 200-bagger because they couldn't be patient. The multi-bagger story takes time to play out. A fast grower needs time to roll out their concept nationally. A turnaround needs time to fix their problems and get back to profitability. A cyclical needs time for the economic cycle to turn in their favor. If you're not willing to wait, don't bother looking for 10-baggers. Just buy an index fund and forget about it. At least you'll capture the market return without doing something stupid. But if you can be patient, if you can find a great company, buy it at a reasonable price, and then just let it compound for 5 or 10 years, you'll beat 90% of professional investors. Because most of them can't be patient either. They're under pressure to show results every quarter. You're not. That's an enormous advantage if you use it. They diversify too much. Okay, here's one that's going to be controversial. People are going to tell you to diversify. Spread your money around. Don't put too many eggs in one basket. And look, there's truth to that. If you're talking about basic asset allocation, you shouldn't have 100% of your net worth in one stock. That's crazy. But when it comes to finding multi-baggers, excessive diversification is your enemy. If you own 50 stocks and one of them goes up tenfold, it barely moves the needle on your overall portfolio. You've got 2% of your money in that stock, it goes up 10 times, so it adds 18% to your total return. Nice, but not life-changing. Now imagine you own 10 stocks and you've got 10% in that same 10-bagger. It goes up tenfold, and that adds 90% to your portfolio. That's a completely different outcome. Warren Buffett has said that diversification is protection against ignorance. If you don't know what you're doing, spread your money around and hope for the best. But if you do know what you're doing, if you've done your research and you've found great companies, concentrate your bets. When I was running Magellan, I had hundreds of stocks, but I had big positions in my best ideas. I had 5% or more in my highest conviction stocks. Those are the ones that really mattered. Those are the ones that made the difference in performance. For an individual investor, I think you can do just fine with 10 to 15 stocks, maybe 20 at the most. Pick different industries so you're not overly exposed to one sector. But don't own 50 stocks. You can't possibly follow 50 companies closely enough to know when something's changing. And here's the other thing about diversification when it comes to multi-baggers. You need to give your winners room to run. If you've got 10 stocks and one of them doubles, it's now a bigger part of your portfolio. Good. Let it be a bigger part. Don't trim it back just to rebalance. That's selling your winner to buy more of your losers. That makes no sense. If the story is still intact, if the company is still growing, if the valuation is still reasonable, let your winner keep winning. That's how you get 10-baggers. You let one stock grow from 5% of your portfolio to 10%, then to 20%, then to 30%. You let it become enormous because the company's doing everything right. Most people do the opposite. They sell their winners to take profits, and they hold their losers hoping they'll bounce back. That's the disposition effect again, and it guarantees mediocre returns. Look, I'm not saying you should bet the farm on one stock. That's reckless. But I am saying you should concentrate your portfolio on your best ideas. 6 or 7 stocks where you really understand the business and believe in the growth story, that's enough diversification to protect you if 1 or 2 go bad. And it's concentrated enough that a 10-bagger actually changes your life. They listen to Wall Street analysts. Oh boy, here we go. This is one of my favorite topics. Wall Street analysts, the experts, the people on TV with their fancy suits and their confident predictions. Most of them have no idea what they're talking about when it comes to finding 10-baggers. In fact, listening to them is a great way to make sure you never see a 10-bagger. Here's why. Analysts work for big brokerage firms. They cover big companies because that's where the trading volume is, that's where the commissions are. They're covering companies with $50 billion market caps, companies that everyone already knows about. Those companies aren't going to be 10-baggers. By the time an analyst is covering a stock, writing research reports about it, appearing on TV to talk about it, the stock has usually already had its big move. The 10-bagger opportunity was 5 years ago when the company was small and nobody cared. I found Dunkin' Donuts before the analysts did. I found Taco Bell before Wall Street cared. When I bought these stocks, there were no research reports, no price targets, no TV interviews. That's when the opportunity was best. Once the analysts show up, once everyone's talking about the stock, once it's on the cover of magazines, the easy money has usually been made. Not always, sometimes great companies keep growing for decades. But the period of explosive growth, the period where you can make 5 or 10 times your money in a few years, that's usually over. And here's the other problem with analysts. They're wrong all the time. They upgrade stocks at the top and downgrade them at the bottom. They get caught up in the same emotional cycles as everyone else. They're optimistic when everyone's optimistic and pessimistic when everyone's pessimistic. I remember during the 1987 crash, analysts were putting out reports saying we were headed for a depression, you should sell everything, the world was ending. If you'd listened to them and sold, you would have missed one of the greatest bull markets in history. The market fully recovered within 2 years and went on to new highs. Or think about 2008 and 2009. At the bottom of the financial crisis, analysts were apocalyptic. Everything was going to zero. If you'd bought stocks in March 2009 when everyone was terrified, you would have made a fortune, but the analysts were saying sell. The point is, analysts are looking backwards. They're analyzing what already happened. They're not telling you what's going to happen. And when it comes to small, undiscovered companies that could be 10-baggers, They're not looking at those companies at all. So how do you find these companies? You use your own eyes. You pay attention to your own experience. You notice which products are gaining traction. You notice which stores are busy. You notice which services people are excited about. Then you do your own research. You look at the financial statements. You figure out the story. You decide if it makes sense. That's how you find 10-baggers. Not by reading analyst reports, not by watching TV, not by following the crowd, by doing your own homework on companies that nobody else is paying attention to yet. They try to time the market. Let me tell you something that's going to save you a lot of grief. Market timing doesn't work. It's impossible. Nobody can do it consistently. Not me. Not the smartest people on Wall Street. Not the professors with their complicated models. Nobody. Yet people keep trying. They try to predict when the market's going to crash so they can sell. They try to predict when the market's going to bottom so they can buy. They waste enormous amounts of time and energy trying to figure out what the market's going to do next month or next quarter. It's a complete waste of time. Here's what I know about the market. It goes up over the long run. Over any 20-year period, it's almost always higher than it was at the beginning. But in the short run, it bounces around like crazy. It drops 10% or 20% or even 50% sometimes. Then it recovers. Then it goes to new highs. If you're out of the market trying to time your entry, you'll miss the best days. And the best days make all the difference. Studies show that if you miss just the 10 best days over a 20-year period, your returns drop dramatically. And you know when those best days happen? Usually right after the worst days. Right after a crash. Right when everyone's the most scared. So if you're sitting on the sidelines waiting for the perfect moment, you'll probably miss the bounce. You'll watch the market recover without you. Then you'll finally get back in after it's already gone up 30%, and you'll have missed the entire move. I've seen people make this mistake over and over. They sell during a downturn to protect themselves, and then they're too scared to buy back in when stocks are cheap. By the time they feel comfortable getting back in, the market's at new highs, and they've missed the opportunity. Here's a better approach. If you've found a great company at a reasonable price, buy it. Don't wait for a market crash. Don't wait for a pullback. If the stock is cheap relative to the earnings and growth prospects, just buy it. And once you own it, don't sell just because you think the market is overvalued or because you're worried about a recession. If the business is doing well, if earnings are growing, hold on. Let the company's growth do the work for you. Recessions happen. Bear markets happen. Your stocks will go down sometimes. Get over it. If you can't stomach a 40% drawdown without panicking and selling, you shouldn't be in stocks at all. I went through the crash of 1987. The market dropped 22% in one day. One day. It was terrifying. A lot of people sold everything, but I looked at my companies. Were they still good businesses? Were they still earning money? Yes. So I held on, and in some cases I bought more. Within 2 years, the market was back to new highs. That's the kind of mentality you need. You're not investing in the market, you're investing in businesses. Good businesses keep earning money, whether the market is up or down. And over time, the stock price follows the earnings. Market timing is for people who don't understand investing. It's for people who think stocks are just pieces of paper that bounce around randomly. But stocks aren't pieces of paper. They're ownership stakes in real businesses. And if you own good businesses, you don't need to time the market. You just need to be patient. They don't know when to sell. All right, now let's talk about the flip side. I've spent a lot of time telling you to hold on to your winners, to be patient, to let your 10-baggers develop. But that doesn't mean you hold forever, no matter what. There are times when you should sell. You just need to know what those times are. First and most important, sell when the story changes. Remember, you bought the stock because you understood the story and believed in it. Maybe it was a fast grower expanding into new markets. Maybe it was a turnaround fixing its problems. Maybe it was a cyclical at the bottom of the cycle. If that story changes, you should think about selling. If the fast grower stops growing, sell. If the turnaround isn't actually turning around, sell. If the cyclical has had its big run and the economy is starting to slow down, sell. Let me give you a specific example. Say you bought a fast grower in the restaurant business. They've got 50 locations, and they're planning to expand to 500. That's the story. That's why you bought it. Now, fast forward 5 years. They've got 450 locations, and they're starting to run out of good real estate. Growth is slowing from 25% a year to 10% a year. The P/E ratio is still 30. That's a problem. The story has changed. They're not a fast grower anymore. They're becoming a stalwart. But the valuation still reflects the old growth rate. That's your signal to sell, or at least trim your position. Second, sell when the valuation becomes absurd. Even if the story is still intact, even if the company's still growing, there's a point where the stock price gets so far ahead of the fundamentals that it makes no sense. If you own a stock that's trading at a PE of 50 and growth is slowing to 15% a year, it's probably time to sell. The PEG ratio is over 3. That's expensive. The stock has gotten ahead of itself. Take your profits and move on. This happens in bubbles. In the late 1,990 seconds, internet stocks were trading at 100 times sales, not earnings, sales. That was insane. If you were smart, you sold. If you held on because you thought the internet was the future and valuations didn't matter, you lost 80 or 90% of your money in the crash. Third, sell when you find something better. This is probably the best reason to sell. You've got limited capital. If you find a more attractive opportunity, a better business at a cheaper price, it makes sense to sell something you already own and buy the new opportunity. I did this all the time at Magellan. I'd buy a stock, it would do well, and then I'd find something even better. So I'd sell the first stock and redeploy the capital. That's smart portfolio management. But here's what you should not sell for. Don't sell just because the stock has gone up. Don't sell just because you've doubled your money. Don't sell because you're nervous about the market. Don't sell because some analyst downgraded the stock. Don't sell because you need to rebalance your portfolio back to some arbitrary allocation. Those are all terrible reasons to sell. They're emotional reasons. They're not based on the fundamentals of the business. Think about it this way. Every time you sell, you're making a decision that the company is no longer a good investment at the current price. You're saying you'd rather have cash than own this business. Make sure you have a good reason for making that decision. Because if you sell all your winners after they double, you will never see a 10-bagger. It's mathematically impossible. A 10-bagger means you hold through the double, through the triple, through the 5 times return, all the way up. That requires conviction. It requires understanding the business well enough to know that the growth story is still intact even after the stock has already done well. It requires ignoring all the people telling you to take profits. It's hard, but that's why most people never see a 10-bagger. They don't have the conviction to hold when they're up big. They sell and they miss the rest of the move. They fall for the latest hot trend. Here's another mistake that kills people. They chase trends. They hear about artificial intelligence or cryptocurrencies or electric vehicles, and they rush to buy the hottest stocks in those sectors without doing any fundamental analysis. This is not investing. This is speculation, and speculation is a great way to lose money. Every few years there's a new hot sector. In the late 1,990 seconds it was internet stocks. In the mid-2000s it was housing and financial stocks. In the 2010 seconds it was cannabis stocks. Every time people convince themselves that this time is different, the old rules don't apply, valuations don't matter because this is the future. And every time it ends badly. The bubble pops, the stocks crash, the people who chase the trend lose most of their money. Now, I'm not saying you should avoid new technologies or new industries. Some of the best 10-baggers come from companies that are doing something genuinely innovative. But you need to do the same fundamental analysis you do for any other stock. Does the company make money? Do they have a path to profitability? What's the competitive landscape? How much debt do they have? What's the valuation relative to earnings or sales? Can you explain the business model in simple terms? If you can't answer those questions, don't buy the stock. I don't care how exciting the technology is. I don't care how much everyone's talking about it. If you don't understand how they make money, you're gambling. I missed plenty of great stocks because I didn't understand them. I didn't buy Microsoft as early as I should have because I didn't understand the software business at first. But you know what? I also avoided a lot of disasters by sticking to businesses I understood. I'd rather miss an opportunity than lose money on something I don't understand. There are always more opportunities. There's always another stock to buy. But if you lose 70% of your capital chasing some trend you don't understand, it takes a 233% gain just to get back to even. That's a deep hole to climb out of. So be skeptical of hot trends. Be skeptical of stocks that everyone's talking about. Be skeptical of companies with no earnings and stratospheric valuations. Sometimes those companies work out. Usually they don't. Stick to businesses you understand. Stick to companies with real earnings and reasonable valuations. Stick to industries where you have some insight. That's boring advice, but boring advice is how you get rich, slowly and surely. They ignore the balance sheet. Let me tell you about a mistake that's easy to make and can cost you everything. People focus on the income statement, revenue, earnings, growth rates, and they completely ignore the balance sheet. That's dangerous. The balance sheet tells you whether a company can survive hard times. It tells you if they have too much debt. It tells you if they have enough cash. It tells you if there's hidden value in assets. This stuff matters. I've seen companies with beautiful income statements, growing revenues, growing earnings. Everything looks great, and then they go bankrupt because they had too much debt and not enough cash. When the economy turned down or their growth slowed, they couldn't service their debt. Game over. Here's what I look at on the balance sheet. First, debt. How much debt does the company have relative to equity? If the debt-to-equity ratio is over 1, I get nervous. If it's over 2, I need a really good explanation for why that debt is there and how they're going to pay it down. Some companies can handle high debt. Utilities, for example, have predictable cash flows, so they can carry more debt. But if you're talking about a retailer or a technology company, high debt is a red flag. Second, cash. How much cash does a company have? Do they generate cash from operations, or are they burning cash? A company that generates strong cash flow can weather almost any storm. A company that burns cash is one bad quarter away from disaster. Third, assets. What assets does the company own? Do they own their real estate or do they lease? Do they have patents or brands that are valuable? Sometimes companies have assets on their balance sheet worth more than the entire market cap. That's an asset play, and it can be a fantastic investment. The point is, you can't just look at earnings. You need to look at the whole financial picture. A company with moderate earnings growth, low debt, and strong cash flow is often a better investment than a company with high earnings growth, massive debt, and negative cash flow. Don't ignore the balance sheet. It saved me from countless disasters. It'll save you too. They don't actually do any research. Okay, here's the big one. The real reason most people never see a 10-bagger. They don't do any research. They buy stocks based on tips from friends, articles they skim, things they hear at parties. They don't actually look at financial statements. They don't visit stores. They don't read annual reports. They don't do anything. That's insane. You're taking your hard-earned money and investing it in a company, and you can't be bothered to spend a few hours understanding what you're buying? Let me tell you what real research looks like. When I was interested in a retail company, I'd visit the stores. I'd talk to customers. I'd talk to employees. I'd see if the stores were busy or empty. I'd look at the merchandise. I'd compare it to competitors. Then I'd go home and read the annual report. I'd look at the financial statements. I'd calculate ratios. I'd figure out if the stock was cheap or expensive. I'd think about the growth runway. I'd identify the risks. That's research. That takes time. But that's how you find 10 baggers. You put in the work that nobody else wants to put in. Most people won't do this. They think it's too hard or too boring. So they take shortcuts. They buy whatever's hot. They follow tips. They chase performance. And they wonder why they never make any money. Look, I'm not saying you need to be a professional analyst. You don't need to build complicated financial models. But you do need to understand the business. You need to read the annual report, at least the letter, to shareholders and the financial statements. You need to understand how the company makes money. You need to know if they have debt problems. You need to have a reason for owning the stock beyond, I heard it was good. This stuff isn't rocket science. The annual reports are available for free online. The financial statements are there for anyone to read, but nobody reads them. They'd rather watch a TV show or scroll through social media. If you're willing to put in just a little bit of effort, if you're willing to spend a few hours doing research on each company you invest in, you'll have a huge advantage over 95% of individual investors. Because 95% of people don't do any research at all. And that's your opportunity. While everyone else is chasing tips and following the crowd, you can be quietly finding undervalued companies that nobody's paying attention to. You can be identifying the next Dunkin' Donuts or Taco Bell before Wall Street discovers it. That's how you get 10 baggers. Not by luck, not by gambling, by doing the work. The real secret to finding 10 baggers. All right, we've covered a lot of ground. We've talked about all the mistakes people make that prevent them from seeing 10 baggers. Now let me give you the positive framework. Here's how you actually go about finding stocks that can go up tenfold. First, look for small and mid-cap companies with strong growth. Companies between 300 million and 10 billion in market cap. Companies growing revenues and earnings at 20% or more per year. Those are your candidates. Second, Focus on industries and companies you understand. Start with your own life. What products do you use? What stores do you shop at? What services do you pay for? What trends are you noticing? That's your edge. Use it. Third, make sure the company has a sustainable competitive advantage. What makes this company special? Why can't competitors just copy what they're doing? Is it a brand, a patent, network effects, operating efficiency? There needs to be something that protects their position. Fourth, look for companies with room to expand. Can they open more locations? Can they enter new markets? Can they launch new products? A company that's already saturated its market isn't going to be a 10-bagger. You need growth potential. Fifth, check the balance sheet. Make sure the company isn't over-leveraged. Make sure they're generating cash. Make sure they can fund their growth without taking on dangerous amounts of debt. Sixth, look at the valuation. Calculate the PEG ratio. If it's below 1, the stock might be cheap. If it's above 2, it might be expensive. Somewhere around 1 is fair. You don't need to buy stocks at bargain basement prices to get 10-baggers, but you do need to pay a reasonable price. Seventh, and this is crucial, understand the story. What's the thesis? Why is this stock going to go up? Can you explain it in 2 minutes? If not, keep working on it until you can. Eighth, be patient. Once you buy, hold on, check the story every quarter, make sure it's still intact. But don't sell just because the stock goes up or because you're nervous about the market. 10-baggers take time to develop. Give them that time. Ninth, let your winners run. If you've got a stock that's up 100%, don't automatically sell. Check the story. Is it still intact? Is the company still growing? Is the valuation still reasonable? If yes to all three, hold on. This might turn into a 5-bagger or a 10-bagger if you don't get in your own way. 10th, keep it simple. Don't buy complicated businesses you don't understand. Don't buy stocks because they're trendy. Don't follow tips. Do your own research on simple businesses with clear growth paths. Those are the stocks that make you rich. That's the framework. It's not complicated. It doesn't require advanced math or insider information. It just requires discipline, patience, and a willingness to do basic research that most people can't be bothered to do. Why this actually works? Let me wrap this up by telling you why this approach works. It's not magic. It's not luck. It's about exploiting the inefficiencies in the market. Wall Street doesn't pay attention to small companies. They're too small to generate meaningful commissions. Analysts don't cover them. Institutional investors don't buy them. That means these stocks can be mispriced for long periods of time. They can be cheap even though they're growing rapidly. That's your opportunity. While everyone else is focused on the mega caps, you can be quietly accumulating shares in the next great growth company at a reasonable price. Then you just hold on and let the company execute. Eventually, Wall Street will notice, analysts will start covering the stock, institutional investors will start buying. The stock will get re-rated, the P/E ratio will expand as people recognize the growth story, and by that point, you've already got a 5-bagger or a 10-bagger. That's how it worked with Dunkin' Donuts. That's how it worked with Taco Bell. That's how it worked with dozens of other stocks I found. I got there before Wall Street. I accumulated shares at reasonable prices. Then I sat back and let the business grow and let Wall Street eventually recognize what I'd already figured out. You can do the same thing. You don't need to be a genius. You don't need inside information. You just need to pay attention to the world around you, do basic research, and have the patience to hold on while the story plays out. Most people can't do this. They're too impatient. They're too emotional. They're too lazy to do the research. That's fine. That creates opportunities for you. The next 10-baggers out there right now, there's probably a company you've heard of. Maybe you use their product. Maybe you see their stores in your neighborhood. Maybe your kids won't stop talking about them. Pay attention. Do the research. Buy the stock at a reasonable price. Hold on. And in 5 or 10 years, you might have a 10-bagger on your hands. That's how it's done. It's not complicated. It's just hard. Because it requires going against your emotions, tuning out the noise, doing work that nobody else wants to do, and having patience that nobody else has. But if you can do those things, you'll beat the market, you'll find 10-baggers, and you'll build real wealth over time. Now get out there and start looking. The next great company is waiting for you to discover it.